Today, I want to share with you some insights on money and taxes. Oftentimes, things happen that we kind of get a little out of control. Either we spend too much, our earnings decrease, and we don't decrease our spending or our expenses fast enough. We owe the IRS or at some other taxing authority, and we get nervous. And what ends up happening is oftentimes we end up going first into denial, like, oh, this is just temporary, this didn't really happen. And so it kind of makes the problem worse. You know what? We're human. Things happen oftentimes outside of our control. The only thing we ever have control over is our own beliefs, our own reactions, and the responsibilities that we take. So I wanted to share with you, especially since here in the US, tax season's coming up, and it's a time of the year that people can get really anxious. And let me just give you a couple of examples of, like things that may have gotten you off track, and it might, resound with you. It might make you start to think differently if this should end up happening to you. So over the many decades that I have been an accountant doing taxes, there have been a number of reasons why people get behind in their taxes. And the most common one is an unpleasant, sudden event in their life that really just throws them for a loop. A death in the family, an unexpected divorce. Like, there are a number of things that can be really traumatic, an accident, illness, or maybe not so much, that breakup, but it really throws you into a funk. And tax deadline will go by and you didn't file for an extension, or you filed your taxes yourself because you were embarrassed to bring the fact that you lost your job or had a significant decrease in your revenues to your accountant. And so you try doing it yourself. So there's two things that you can do about that. One is have a professional look at what you've done, because sometimes you don't take all of the things that you're entitled to, all the deductions or the credits, or you took some that you weren't entitled to, and the IRS has caught up with you and said, hey, you owe, $1,500, $5,000, $10,000, $50,000, whatever it happens to be. Don't panic and bury your head in the sand and not open up those tax letters, because the IRS wants to collect, but they don't want to put you out of your house. They don't want, you to not be able to survive this. And oftentimes they'll work with you and you can make a payment plan, because even in bankruptcy, IRS debt does not go away, nor does federally backed student loans. So keep those two things in mind. Because a lot of times people think, well, worst case scenario, I'll file for bankruptcy and be able to start with a clean slate. And that's not true. Yes, it can get rid of some debt. And, you don't want to be filing bankruptcy all the time, because it totally ruins your credit. And sometimes it's not avoidable. Let's go back to those illnesses. So say you were in the hospital, deadline completely goes by, your accountant doesn't automatically file an extension for you. What can you do? This moment you realize what has happened, you want to prepare that tax return and file it as soon as possible, because penalties of both late filing penalty and interest on any money that's owed are compounded daily. So the longer you take to kind of own up to what's going on and get back on track, the better, because the fewer penalties and interest. Now, you can ask to have penalties abated. You cannot have interest abated. So, not with the IRS anyways. So there are ways that you can help to reduce or to structure a payment plan that you're going to be able to live with. And I highly suggest that you use a tax professional when doing that. The other thing is, oftentimes when you are in business for yourself, and you're filing your own taxes, or you're dealing with a tax preparer that is not really well versed in small business tax, home-based business tax, a lot of times accountants will say, oh, well, you don't want to depreciate your home, so you don't want to take your home office deduction. Well, you don't have to depreciate your home. Depreciation is a choice. You can choose to recoup the capital that you've put out for assets by the use of depreciation, but you do not need to depreciate your home. You definitely do not need to do that. But the one caveat with a home-based business is you need to have a separate room that you use only for business. So you can't use your dining room and also have family dinners on that dining room table, because it doesn't qualify. But there are so many things that do qualify. So say you have a spare bedroom, you decide to turn into your home office. The square footage of that room to the square footage of the entire living space, that percentage you can use to offset business income, things like real estate taxes, mortgage insurance, major repairs, like repairs and maintenance. If you see clients here as well, or you stock inventory in a spare room, there are many things that you can take. Then any of the repairs, like you put fresh paint on the walls in your office, you can deduct that. But if you paint your living room, can't deduct that. If there's other maintenance like snow removal, so that clients can come uh, to see you for business. So there are many things. Same thing with your cell phone, right? If you're using your cell phone number as your business number, then a portion, not all, but a portion of that can be deducted. One of the things that people sometimes get a little bit confused and hung up on is mileage. So if you're using your own personal business car, or your own personal car for business, and you want to deduct the mileage going to clients or other business related events, the thing is, the mileage does not stop when you leave your home. It starts after the first stop. So if you go to a business networking event and come straight back, there's no mileage that's deductible, because they want to offset what would be considered commuter miles. So I always highly recommend that you rent a post office box for your business close to your home, and make that your first and last stop of the day, so that your commuter miles are those miles between your home and the post office. And then your business miles are from the post office to your next business event. Now, if you go, say, to a business networking event and then you have a doctor's appointment, you want to measure the miles between the post office and the networking event. You cannot measure the miles between the networking event and the doctor's office. However, if you go from the doctor's office then to another business um, expense venue, then from that point back to the post office, check, make sure you got any more mail, or drop off something you forgot to drop off, and then come home. That miles between that last business stop and the post office is deductible. So if you have, and some people go like, oh, that is like a lot of work. Well, do it for a year. If your mileage is very similar year after year after year, you want to keep the records of that 1 year and make that your standard, right? So if your standard mileage is 60% of all your mileage is business, then you can say 60% each year thereafter. Now, there's a couple of things that you want to keep in mind. You can either take mileage, which oftentimes it's easier to track, or you can take that percentage, say that 60% of all of your auto expenses. So gas, repairs, if you have to rent a vehicle for any particular reason, because like your car is in the shop, that percentage would be against all of those things, that you cannot take both. So it's usually better to see just how much of your time really is spent with mileage, and think about, like, does it make sense? Whatever makes sense is the one that you're going to want to stick with. So I hope that was a helpful tip because a lot of times people get confused about that. So what happens going back to the, sometimes we get off track and we don't file, or we file and we owed money. There's a couple of things that you can do. So say you filed and uh, there was some mess up and you owe $1,500 and you think, oh my God, how am I going to pay that? So usually if you offer, there's a form that you can fill out with the IRS, and usually file it with the tax return that you know you owe that money and you don't have the money to pay the funds. So like if your accountant comes back to you and says, "Oh, you've got, here's your e-file authorization, sign it, return it, and oh, by the way, you owe the IRS $1,500," and you go like, "Oh my God, I don't have $1,500. How am I supposed to do that?" Whatever you do, don't just sign the e-file and send it back, because the accountant's going to think you got the money, it's either coming out of your account, you're writing a check, whatever it is, and they're going to file that. What you want to do is go back to that accountant and say, "I don't have the funds to do that. Can we file asking for an installment agreement?" And so typically you're going to want to put 10 or 20% down, whatever, the best thing that you can do is to put down. And then a percentage each month till you get that paid off. Um, if you owe both the IRS and the state, it's almost always, depending on the state, but it's almost always better if you have the funds to completely pay the state, pay them fast first, then deal with the IRS. A lot of people will think the other way around, but oftentimes a lot of the state's interest rates and penalty rates are higher than the IRS, believe it or not. So if you have to make those choices, then just chat with your professional, because they should be able to advise you. And if you aren't getting the advice from the advisor that you want, get yourself another advisor. You're paying them for their advice. And if they're not willing to communicate with you, walk you through things that you don't understand, then they're not a right fit for you. That doesn't mean that they're not a good professional. It means they're not a right fit for you. So find someone who is the right fit for you. Hope those were helpful tips.